Okay, let's dive into this. Welcome to today's Explainer, where we're actually putting on our professional equity analyst hats. We're going to run a rigorous live case study on calculating the true intrinsic value of a company, specifically the natural gas producer CNX Resources. You see, valuation isn't just pulling a number out of thin air, right? It's a structural process. It's a toolkit of mathematical frameworks that helps us separate a company's underlying actual worth from its day-to-day market price. So today, we are opening up that toolkit.
Our baseline mystery starts right here, $37.88. That is CNX's last closing stock price. But as any focused learner or financial analyst knows, price is simply what you pay. Value is what you get. So, is that nearly $38 price tag a bargain? Is it a fair deal? Or are we looking at a massive premium? To solve this mystery, we really have to look past the ticker tape and dive deep into the company's financial DNA.
And this brilliantly illustrates exactly why we need a rigorous valuation process. Look at this massive disparity. If we calculate fair value based purely on free cash flow, we get $36.38 per share. But an earnings per share growth model, that spits out a massive $203.70. That tells us immediately that one of these metrics is completely distorted by temporary anomalies, and there's no way we can just take these numbers at face value.
To figure out where the truth actually lies, here is our structural roadmap. We'll start with the challenge, unpack absolute valuation, jump into relative valuation, check out asset-based valuation, and then synthesize it all for our final verdict.
All right, Section 1, the challenge, getting our baseline metrics. Step 1 in any professional valuation is to clear away the noise. We need to extract the raw, foundational metrics. Before we can run any complex discounted cash flow equations, we have to know what kind of machine we're actually dealing with. Is it debt-heavy? Is it highly profitable? Well, here's the raw profile for CNX. It's a mid-cap company with a market capitalization of roughly $5.388 billion. And over the trailing 12 months, it generated a very healthy $533.9 million in free cash flow. Crucially, its balance sheet is quite manageable, sporting a debt-to-equity ratio of 0.57. That's a moderate debt load, which definitely lowers our risk profile. Meanwhile, its return on invested capital sits at 7%. So these are the foundational numbers we're going to use to build our models. The cash generation is strong, and the debt is totally controlled.
Let's move to Section 2 and see how this builds. We are stepping into absolute valuation models. In this category, we honestly don't care what the broader stock market is doing. We are looking absolutely and exclusively at CNX's ability to generate cold, hard cash for its owners over its entire lifetime. The absolute crown jewel here is the discounted cash flow model, or DCF. The theory is brilliantly simple. A company is only worth the sum of all the cash it will ever produce in the future, discounted back to what that cash is worth today. Because obviously, money today is worth way more than money tomorrow due to inflation and risk. So we apply a discount rate to those future earnings.
Let's walk through the actual math based on the data we extracted. Step 1. We use that robust $533.9 million trailing free cash flow as our base. Step 2. We have to apply our discount rate, which is often called the weighted average cost of capital, or WACC. Now, given CNX's moderate debt-to-equity ratio of 0.57, we can sensibly assume a WACC of around 9 to 10%. We're also going to plug in a standard, conservative terminal growth rate of 2 to 3%. This basically accounts for the company's long-term steady state beyond our immediate projection window. Step 3. We run the projections and discount them back to present value.
And when the dust settles on that DCF equation, bam, the data points to an intrinsic fair value price of exactly $36.38 per share. This is a highly grounded number, mostly because cash flow is incredibly difficult for accountants to manipulate. It represents the actual, unencumbered cash the business is pumping out.
Now, another absolute model we usually look at is the dividend discount model, which values a stock based on the present value of its expected future dividends. But honestly, this model heavily struggles with CNX. Why? Well, over the trailing 12 months, the dividend growth is literally 0%. And if you look back 5 years, the dividend compound annual growth rate is actually negative 36.78%. CNX is just simply not a reliable dividend payer right now. Trying to use a DDM here would require massive speculative assumptions about when they might actually reinstate a strong payout. So, for our rigorous analysis, it's virtually useless.
Just to double-check our absolute valuation, we can quickly glance at the residual income model.
This approach starts with the company's book value and adds any excess returns the company generates above the cost of its equity. CNX has a return on equity of 14.60% and that return on invested capital of 7%. Because that ROE is pretty decent, it tells us CNX is indeed generating income above its equity charge, so the residual income is positive, which validates our DCF finding that this is absolutely a value-creating business, even if those excess returns are relatively modest.
Let's shift gears a bit. Section 3. Relative Valuation. Time to look at market pricing.
With our cash flow baseline set, we need to ask the market for its opinion by looking at historical and industry multiples. Conceptually, we'd compare CNX against industry peers in the natural gas sector. Think companies like EQT or Range Resources. Now, what's really interesting about these price-to-earnings or PE ratios is the story they tell us. Currently, CNX trades at a PE of 9.86. If you just look at its trailing 12-month average of 1850, the stock looks like a screaming bargain. I mean, it's trading at nearly a 47% discount to its recent average. But, context is everything. If we zoom out to the 3-year average PE, which sits at 8.56, CNX is actually trading at a slight premium of about 15%. This strongly suggests that while it might look cheap recently, historically speaking, a PE around 9 or 10 is actually quite normal for this company in the current energy environment.
Moving on to Section 4. Asset-based valuation, which is all about finding our downside protection.
Let's open up a different part of the briefcase. This is the ultimate downside protection check. If the company stopped operating tomorrow and we just liquidated literally everything they owned, what would it be worth? To figure this out, we compute the net asset value, or NAV. Simply put, we take the total fair market value of all the company's assets, like its natural gas reserves, its equipment, its real estate, and we subtract all its total liabilities and debts.
To find a baseline NAV per share from our metrics, we can look at the price-to-book, or PB ratio, which currently sits at 1.25. If we take the current stock price of $37.88 and divide it by that 1.25, we derive an implied raw book value of roughly $30.30 per share. So at the very least, the accounting assets on the books are worth about $30 a share. But as any true analyst knows, accounting book value rarely equals actual fair market value. We need to look for clues for adjustments. Our data shows an enterprise value to assets ratio of 0.84. What does that mean? It means the market is currently valuing the entire enterprise at only 84 cents on the dollar compared to its stated assets. In the energy sector, reserves and real estate are often heavily depreciated on the balance sheet, but they hold significant real-world market value. This tells us that if we actually marked those assets to market, the true net asset value per share could easily push higher than $30.30, providing a really solid floor for the stock's intrinsic value.
And that brings us to Section 5, the synthesis and final verdict. Time to bring it all together.
We've run the models, we've extracted the cash flows, compared the multiples, and stripped down the balance sheet. Let's lay all our cards on the table. Our cash flow DCF model gives us a precise 36.38. The earnings per share model spit out that crazy outlier of 203.70. Our relative multiples suggest the stock is cheap compared to last year, but fairly valued against a 3-year timeline. And our absolute floor, the net asset value, sits conservatively around $30.30.
So how on earth do we weigh these wildly different results? Well, we have to look at the company's business model. CNX has posted a staggering trailing free cash flow growth of 93.86%. Because of this incredibly strong, tangible cash generation, our DCF model is highly reliable here. On the flip side, we have to throw out that $203 EPS valuation. Why? Because CNX's net income is highly volatile. It grew 856% in the last 12 months, but it actually shrank almost 40% annually over a 3-year period. Energy earnings are notoriously noisy due to wild commodity price swings. Therefore, the stable, cash flow-based valuation is unquestionably our most reliable anchor. So the crucial point is this. When we completely discard the noisy earnings and speculative dividend models, and we rely on the mathematically rigorous discounted cash flows backed up by a solid asset floor, we arrive at a definitive fair value price of $36.38. With the stock currently trading at $37.88, that leaves us with a margin of safety of negative 4.12%. In analyst terms, the stock is currently slightly overvalued by the market.
The business is generating fantastic cash, and the debt is very well managed. But at today's price, you are definitely paying a slight premium for perfection.
It forces us to ask a critical question. With incredibly strong free cash flows but literally zero margin of safety, is CNX Resources a stock you patiently hold for long-term compounding, or is this just a cyclical value trap waiting to catch the overeager investor? Think about the models, look closely at the cash, and keep asking the hard questions. Until next time, keep exploring the data.